Okay. So our topic today, class, would be PAS 8 or the standard governing your accounting policies, your changes in accounting estimates, and your errors. So at the outset, I would like to tell you that the purpose of this standard class is more on to help us select on what accounting policy to apply in the preparation and the presentation of our financial statements. PAS 8 will also tell us on how to account for changes in accounting policies and changes in accounting estimates. So, number one, PAS 8 will tell us or will help us how to select an accounting policy. Number two, it will tell us how to account for changes for both accounting policies and accounting estimates. And third, PAS 8 would also tell us on how to account for errors. Okay. If you can recall class chapter 5 of the conceptual framework, you were introduced to different measurement bases. And those measurement bases class can be used in the measurement for the subsequent recognition of your assets, liabilities, and equity. Even also for your, uh, we also have recognition principles for your income and expenses. Okay. And out of all those options, class, out of all those measurement bases, an entity has to pick one, has to stick to one policy on how it will measure its assets, liabilities, equity, income, and expenses. So PAS 8 here is here to help us on how to choose among all the options. Okay. But if you have read the entirety of the standard class, you would have also noticed or you would also have learned that there's really not much of selection to do because the standard tells us if the other standards expressly tell you to use a particular measurement base, uh, to use a specific principle, then you will have to follow that requirement of the standard. Okay. So the question now is, if we are to simply follow the requirements contained in the other standards, when then does PAS 8 come in? When then does PAS 8 become applicable? Okay. So PAS 8 class will principally be applicable in instances wherein the other standards give us options. Okay. So it's possible, class, that the standard will give you more than one possible accounting treatment. Okay. So for example, in accounting for your property, plant, and equipment class, okay, to account for your to measure your items of property, plant, and equipment, PAS 16, the standard that governs property, plant, and equipment, gives us two options. We are either to use the cost model or the revaluation model. Okay. And in choosing whether or not to use either the cost model or the revaluation model, we will have to apply the concepts contained in PAS 8. If you will notice, class, the first standards that we are discussing are more of general application. They will apply to the entirety of the financial statements. We started with PAS 1, which is basically the main standard that will govern the overall preparation and presentation of your financial statements. And PAS 7 would be a continuation of your PAS 1. It's just that PAS 7 focuses on a specific financial statement, which is your statement of cash flows. So here we have PAS 8. This is still for general application. We are not yet dealing with specific accounts. We are not yet dealing with specific asset, liability, income, or expenses. Okay. So what I am telling you now is that in case the other standards, okay, the standards that are for specific application gives us options, then we will have to use the concepts contained in PAS 8. Okay. But again, number one rule is you follow whatever is required by the other standards. Okay. If you ask the question, what accounting policy should I use? You follow whatever the specific standard tells us to use. Okay. But here comes PAS 8. PAS 8 is supposed to help us in selecting the appropriate accounting policies. Okay. But if we are to follow the provisions of the other standards, this means that Pass 8 would generally be applicable only if the other standards offer us options. Okay. Second scenario class where in Pass 8, the concepts in Pass 8 can also be applicable is when a specific or a certain transaction or event is not governed by our other standards. Although, as I have told you, class, this will become very rare, but in the interest of being comprehensive class and all encompassing, Pass 8 tells us that we will also have then to apply the conceptual framework. Okay. So the if a certain transaction or event is not specifically covered by an existing standard, then we will have to visit and rely on our conceptual framework. Okay. As to what we will, as to what Pass 8 requires us to do, class, we will be able to uh, go into the details as we move along in the rest of Pass 8 class. Okay. Uh, this came out in one of the in one of the questions earlier class, whether or not Pass 8 governs the disclosure requirements for accounting policies. Okay. Reading paragraph 2, the answer there should be false because the disclosure requirements class are governed by Pass 1 and not by Pass 8. Okay. So even if we're talking about accounting policies, the disclosure requirements for accounting policies is governed by Pass 1. But of course, if we are talking about changes in accounting policies, then it is now Pass 8 that will be applicable because Pass 1 does not touch on the disclosure requirements if there are changes in accounting policies. Okay, so let me just clarify that. Pass 1 contains the disclosure requirements for accounting policies, but it is Pass 8 that provides for the disclosure requirements if there are already changes in the accounting policies. Okay, so although that's a very uh, small detail class, and I doubt that will come out in the board examination or even in your departmental exams. But for the purpose of being precise, the disclosure requirements concerning accounting policies in general is contained in Pass 1. The disclosure requirements concerning changes in accounting policies uh, are contained in Pass 8. Okay. Now, this subject being more of an introduction class, I would want us to immediately go to the uh, main objectives, the main learning objectives from studying Pass 8 class. Okay. So basically, I do not expect you to be able to choose on your own class what accounting policies to use because again, number one, the standard will dictate as to what policies will be used. Number two, when you will be actually working class, by the time you join the workforce, by the time you join your company, these accounting policies are already in place. Okay, so when you join the company, it's your task will be more on the execution already, more on the application of the existing policies that had long been set by the company. Okay, but as far as your examinations are concerned, class, the main learning objective in studying Pass 8 would be to know how to treat, number one, changes in accounting policies, number two, changes in accounting estimates, and number three, how to account for prior period errors, class. So for me, if you are only capable of remembering three things, class, out of everything that will be discussed concerning Pass 8, let it be the accounting treatment for changes in accounting policies, changes in accounting estimates, and accounting for prior period errors. Okay, so take to heart these three and remember their accounting treatment class. Okay, and as far as memory recall is concerned, class, it should be very easy. Okay, before going into the definition class. Okay, let's just cover the principal learning objective here. Number one, if there, how to account for what's the treatment for changes in accounting policies? The answer is uh, retrospective application. Okay, the answer is retrospective application. If you have gone over the definition of terms class, you should have encountered retrospective application, meaning the change is to be applied retrospectively. And what do we mean by retrospective application? The the change class, the the application of the change should be applied as far back as possible, class. Okay? If we are dealing with measurement of PPE, then we go back to the very first period in which we had an item of PPE. Okay? So you really don't have to go back to the first year of operation. You just go back to the year in which this accounting policy was first used, class. Okay? When we talk about retrospective application, it's more of backward looking, class. You apply the change as far back as possible on the very first year in which the policy has become relevant. Okay, but as we will discuss later on, that will not actually what will happen, class, but that is what is prescribed by retrospective application. Okay, so again, if we're dealing with changes in accounting policies, what's the treatment? The change in accounting policy is to be treated by applying it retrospectively, backward looking by applying it to the past periods, as if this new policy, the the new policy that we have adopted, it's as if this new policy had been used from the very beginning. Okay, so if conceptually speaking, when we're talking about retrospective application, it's very cumbersome, class. It's very tiresome to think of, because you're supposed to apply it from the very beginning. The policy becomes relevant, that the policy became applicable. Okay, so in theory, it should be very tiresome to apply, because if the entity had been dealing with PPE in the last 20 years, then you're supposed to apply it in the past 20 years as if it had been in application 20 years ago. Okay, but again, later on, we will learn that what normally happens with that, it will just be applied as far back as the beginning, as far back as the start of the previous year. Okay, but we will clarify that later on. But as far as theory is concerned, when we talk about retrospective application, class, it's as if the new the new accounting policy that we are using had been used from the very beginning, from the very first time that these uh, accounting policies had become relevant. Okay, but again, if we are capable of remembering very little lang, class, let it be that changes in accounting policies are to be applied retrospectively. And what does retrospective application mean? It means to apply the new policy on the past periods, as if it had already been in use from the very beginning. Okay, again, you don't have to confuse yourself so much, class. Just remember those uh, two basic concepts. Number one, change in accounting policies are to be applied retrospectively, and retrospective application means we are going to apply the new accounting policy as far back as possible. We are going to apply it as in the past periods as if it had been in use from the very beginning. Okay. Second principal learning objective, class, the treatment for changes in accounting estimates. Okay. Again, we have discussed it before that the preparation of your financial statements involves a lot of estimates. Okay. And it's possible that the basis of our estimates, class, you can recall that the use of estimates is okay as long as the the process behind the use of the estimates, class, is reliable and uh, it can be verified, class. Okay. So if ever the basis of our estimates, class, will change, then of course we will have to adjust our subsequent estimates. Okay. But as far as our principal learning objective is concerned, we are expected to know the changes in accounting estimates are to be applied prospectively. Okay. So basically, prospective application class will be the opposite of your retrospective application. When we are talking about retrospective application, it's more of backward looking. If we're dealing with prospective application class, it's more of current and or forward looking. Okay, the changes then in the estimate will be applied in the current period or in the current period and the subsequent period. Why do I not just say current and subsequent? Why do I have to separate current and subsequent? Because there are some estimates class that will no longer be of use in subsequent periods. Of course, we will not apply it in subsequent periods if it is no longer of use. Okay? So if ever the estimate class is only good for the current year, then you only apply it for the current year. But more often than not, your estimates class will be applicable for the current year and for the subsequent year. That is why most students would think that when we are dealing with prospective application, it only means current and subsequent. That subsequent is always included. Okay. But if we are going to be very strict as to the provisions of the standard class, this would tell us that prospective application could actually mean that the change will only be applied in the current period only. Okay. And why will that be possible? Because it's possible that the estimate is no longer of use in the subsequent period. So if it is no longer of use in the subsequent period, then there is no point in applying it in the subsequent periods. Okay. So there's actually two ways. There are two angle class in which we can use prospective application. Prospective application can either mean apply it this period only or apply it this period and for the subsequent periods. Okay. Again, most students would think that when we are talking about prospective application, opposite lang, it is simply the opposite of your retrospective. If retrospective is backward looking, uh, prospective is always forward looking. No, prospective can simply be current for current use only. So it's either current year only or current year plus subsequent periods. Okay. But again, let's try to simplify what is expected from us, class. Okay, the most basic changes in accounting policies are to be applied retrospectively. Retrospective application is to apply the new policy as if it to apply it in the past periods as if it had been in place from the very beginning. Second, changes in accounting estimates are to be applied prospectively. And when we talk about prospective application, it is to apply the change in estimate. It is to apply the change in the current period or in the current period plus the subsequent period. A third, errors class. Okay. There are actually two kinds of errors class. Errors for the current year and prior period errors. Okay. If we are talking about current period errors class, errors for the current period, then there's no need for an extensive accounting treatment class. If the error happened this year, then simply change or correct your records for this year. Just simply prepare a correcting entry. Okay, it should not have any effect on your past financial statements, and it should not also be included in your current financial statements. If the error happened this year and it was discovered this year, then you make the necessary corrections before you issue your financial statements. Okay, so there should not be a big issue or concern when we are dealing with current period errors. Okay, errors for the current year that are discovered before the financial statements were issued. If that is the case, then simply make the necessary corrections for your current financial statements to reflect the corrected amounts already. Okay. So the primary concern now for past 8 would be how to deal with errors that happen in the previous periods, in the past periods, in the prior years, but were only discovered now. Okay, and that's what we call prior period errors class. These are errors that happened in the past periods and that were just discovered now. Okay, will there be a need to make adjustments class? The answer is yes, because of the errors in the previous period class. Because of the errors in the previous period, past financial statements were erroneous. Okay, why do we not make these significant adjustments when dealing with current period errors? Because again, number one, this does not concern the past financial statements because the error only happened now. When we prepared the past financial statements, the error did not exist yet. And for the current financial statements, we still have time to change or to correct the error before we prepare the current financial statements. So for current period errors class, no financial statements have been misstated. No financial statement had been erroneously prepared. So no need to make significant adjustments. Just simply correct your accounting books. Just simply correct your records. But for prior period errors class, the past financial statements were already erroneous because of the errors that were committed in the previous periods and which were reflected in our previous financial statements. And if we do not make the necessary corrections, class, our current financial statements would also be erroneous. Okay, not only will the past financial statements be erroneous, the current financial statements will also be erroneous, class, if we do not make the necessary corrections. Okay, but again, let's simplify it. Let's simplify it. What is expected from us? We are expected to know. We are expected to know that if there are prior period errors, it will have to be treated by retrospective restatement. Okay, and this is where students get confused because uh, you are now encountering two kinds of retrospective, and many students would uh, interchange class. Okay, so if we're dealing with prior period errors, the accounting treatment is retrospective restatement, meaning you restate your past financial statements as if the error was never uh, as if the error never occurred, class. Okay. Similar to your retrospective application, retrospective restatement would be uh, backward looking also. Okay. So what's now the difference? Retrospective application, you apply the new policy as if it had been in place from the very beginning. Okay. Retrospective restatement, you change your past financial statements as if the error never occurred. So if the error occurred 20 years ago, class, we are supposed to correct everything as far back as 20 years ago. Okay. And again, as we will later on learn, class, uh, the the practical application would just be to restate it, class, to restate the beginning balance of the previous year. But again, we will clarify that later on. What I want you to know lang, that as of this point, the three treatments, class, of the three main discussion points for PAS 8: changes in accounting policies, changes in accounting estimates, and prior period errors. What's the treatment for accounting changes in accounting policies? Retrospective application. What's the accounting treatment for changes in accounting estimates? Prospective application. What's the accounting treatment for prior period errors? Retrospective restatement. Okay. Because if out of everything I have discussed this morning, class, you're only capable of remembering three things, let it be those three things, class. Okay. And of course, please do not forget about the definition of terms. Okay, we have here the definition for your accounting policies. These are the principles, basis, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. You have here a definition of your accounting estimate. We don't have to talk about further the composition of your IFRS class. This is also contained in PAS 1. Okay, we have here, class, the definition for your prior period errors. Prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information that, okay, this can be a good source for a multiple choice question class. When can there be prior period error? Okay, number one, the information was available when financial statements for those periods were authorized for issue, and they could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial events. If the information was not available, class, then it is not our fault that we were not that there is an error in how we handled a certain transaction or event, class. Okay. Uh, the next topic, class, after past 8 would be past 10 account events after the reporting period. So if the information was only available for us, class, after we have prepared the financial statements, then it is not past 8 that will be applicable, class. It would now be past 10, okay, which governs on how to treat for events happening after the reporting period. Okay. This could also be a good source for multiple choice question, class. Examples for errors, okay, effects of mathematical mistakes, mistakes in applying accounting policies, oversights or misinterpretation of facts, and of course your fraud. Okay, if you intentionally presented a different amount, definitely that is an error as well. Okay, it violates our faithful representation goal. Okay, you have here the definition for your retrospective application, as if that policy had always been applied. This is what I was talking about earlier. Retrospective restatement is correcting the recognition, measurement, and disclosure of amounts of the elements of the financial statements as if the prior period error had never occurred. Okay, you can simply gloss over impracticable, class. Prospective application of a change in accounting policy and of recognizing the effect of a change in accounting estimate. Uh, uh, Means applying the new accounting policy to transactions, other events, and conditions occurring after the date at which the policy is changed, recognizing the effect of the change in the accounting estimate in the current and future periods affected by the change. So here you might be confused. Why is prospective application, class, talking about change in accounting policy? Okay. Why is prospective application also talking about change in accounting policy? Because you will remember, class, if uh, the accounting policy, class, is brought about by new requirements by a standard, class, and the standard tells you to apply it prospectively, then of course, class, you will have to follow the standard. The one I mentioned earlier is more of our default treatment, class. So that if you're talking about change in accounting policy, our default treatment would be to apply it retrospectively. Okay. But if the change in accounting policy, class, is brought about by new requirements by a standard, class, and the standard, class, tells you to apply it prospectively, then of course you will have to follow the standard. Okay. But if the new standard is silent, the standard requiring a new accounting policy to apply is silent, then of course the rule is to apply it retrospectively. Okay. I hope you have not gotten used. You have not gotten confused, class. Okay. If anything, class, I prefer that you simply remember change in accounting policy, retrospective application, change in accounting estimate, prospective application, prior period errors, retrospective restatement. Okay. What this paragraph is basically telling us that be open to the possibility that a change in accounting policy may be triggered by a new requirement by the standard, and if the standard tells you to uh, apply the change in accounting policy prospectively, then of course you apply it prospectively. You follow the specific requirement in the standard. Again, as what I have mentioned, past 8 is more of general concepts, class, to be applied if no specific standard is applicable. As to selection, it says here that you will have to follow the standard, which we have already mentioned earlier. Those policies, okay, here it's just a tiny tidbit of information, class, although this rarely comes into play, class. If the policies, class, If the effect of the policies are immaterial, then there will be no need to apply the change. Okay. Let's just read the entirety of paragraph 8. The standard set out accounting policies that the board has concluded uh, result in financial statements containing relevant and reliable information about the transactions, other events, and conditions to which they apply. Okay, those policies need not be applied when the effect of applying them is immaterial. However, it is inappropriate to make or leave uncorrected immaterial departures from the standard to achieve a particular presentation. So if you are intentionally not applying it class because you now have a bias class, okay, you you now have a bias, then definitely that would now be wrong. Okay. But as to how people will know that class, then that would now be a separate issue. Okay. You will have to understand class that the provisions of the standard tend to be very idealistic. Okay, guidance that is an integral part of the IF the standards is mandatory. Guidance that is not an integral part of the standard does not contain requirements for financial statements. Okay. As we go along discussing the other standards class, we will encounter some appendices class. Some standards will have appendix, okay? And in most cases, the standard will tell us that this appendix forms an integral part of this standard, okay? So if that is the case, then the requirements contained in the appendix class would be mandatory, okay? But if ever the appendix class is not considered an integral part of the standard, uh, then it is not going to be mandatory. Okay, so please take note. Again, you will notice this in our discussion in the subsequent standards. Some standards will have appendices class. Okay, and the appendix will specify whether such forms part an integral part of the standard, and in such case, it will be considered mandatory. Okay. Here, paragraph 10 is important class. In the absence of a standard that specifically applies to a transaction, management shall use its judgment. Okay, this can be a good source for multiple choice question. What should you use? Okay, in case the standards uh, are silent as to a certain transaction or event, the number one, the main tool to use is management's judgment class. Okay, and what should be considered by the management class? It should consider the following information, but these are very uh, conceptual lang. Okay? The main takeaway for paragraph 10 class is that on dealing with transactions or events that are not specifically covered by an existing standard, then the primary tool to deal with such transaction or event should be the judgment of the management class. Okay? So as to, in determining what accounting policy to use, then your primary tool, you should primarily rely on management's judgment. Okay, and this would be a recurring sentiment class. Okay, judgment would always be a very important consideration in the preparation of your financial statements. Okay, now paragraph 11 tells us what should you consider in making the judgment class. We have here two in the order of preference. Number one, the requirement in the standards dealing with similar and related issues. So again, we are dealing with a transaction or event that is not specifically covered by the standards. So what do? Apply judgment by using the requirements of the other standards dealing with similar and related issues. Okay, and you also apply the uh, this conceptual framework. This is now when the conceptual framework will come in. Okay. And number 12, additional consideration. Okay. But this is not the primary consideration kasi additional consideration lang. In making the judgment, management may also consider most recent pronouncements of other standard setting bodies. Okay. So we may go outside IASB class. We may use US GAAP, uh, we may use the other standards class issued by a different standard setting body class. Okay. But again, primary consideration, judgment. Okay, and use your judgment by taking into account the other standards dealing with similar and related issues and the conceptual framework. Okay, the other pronouncements from other standard setting bodies class will only be an additional consideration. Okay, this should not be your primary source for uh, deciding on how to account for transaction or event that is not specifically covered by the standards. Okay. Number 13, very conceptual class but important. The main reason that the financial statements are of use class, it's because we apply the same policies year in and year out. Okay? So the relevance of our financial statements class would significantly be affected if we do not apply our accounting policies consistently. Okay. Now, for changes in accounting policies, when do we have these changes? An entity shall change an accounting policy only if number one, required by an standard, and number two, the change in accounting policy will result in better information, will result in better financial statements. Okay. This can be a good source for a multiple choice question. Okay. The same is true for number 16. This can be asked as an multiple choice question. Which of the following is a change in accounting policy? Which of the following is not a change in accounting policy? And if you go over paragraph A and paragraph B of paragraph 16 class, it would make sense why they will not be considered as changes in accounting policy. Okay. The application of accounting policy for transactions or events that differ in substance from those previously occurring. Okay. So we have not previously dealt with this kind of transaction or event. So the first time that we are dealing with this one, and if we are to use a different accounting policy, will not be considered a change in accounting policy. Why? Because this is essentially the first time we are applying this accounting policy. Paragraph B, the application of a new accounting policy for transactions or events that did not occur previously or were immaterial. So similar concept for A and B class. If you are applying a policy basically for the first time, then that will not be considered as a change in accounting policy. Okay, applying changes in accounting policies. An entity shall account for a change in accounting policy resulting from the initial application of a new standard in accordance with the transitional provisions. So if you're dealing with a new standard class, more often than not, that new standard will contain transitional provisions that will be followed to transition from the old standard to the new standard. Then, of course, you follow the transitional provisions. When an entity changes an accounting policy upon initial application of an IFRS that does not include specific transitional provisions, it shall apply the change retrospectively. Okay, this is now what I was referring to, class. The default treatment would be retrospective. Okay, just take note of paragraph 20 and 21, class. Although this rarely comes out, class, please take note of voluntary change in accounting policy, because the rule for voluntary change in accounting policy, class, would be different. Okay, paragraph 22. Retrospective application. When a change in accounting policy is applied retrospectively in accordance with the previous provisions, the entity shall adjust the opening balance of each affected component of equity for the earliest prior period presented. Okay, so although the rule, class, is to apply it as far back as possible, as if the new policy had been in place from the very beginning. Okay, but what actually happens, class, is that you will just have to adjust the opening balance or the beginning balance of the earliest prior period presented. Now, what is this earliest prior period presented? Normally, the earliest prior period presented, class, will just be the previous year. Okay, as you should have learned in past one, class, aside from presenting the current period amounts, the figures for the current period financial statements, class, you would also present a comparative figure from the previous year, from last year. So that being the case, our financial statements normally presenting the current year and the previous year, the earliest prior period presented then would normally be just the last year. Okay? So if we have changes in accounting policies, all you have to do, class, is to adjust the opening balance. And what do we mean by opening balance? Adjust the beginning balance of the earliest prior period presented. And what is the earliest prior period presented? It will simply be the last year. So basically, when we say retrospective application, we just have to adjust the beginning balance of the last year, class. And how will our financial statements look like now? Normally, it will just be two columns, class. The first column for the current year, the second column for the last year. Because of the retrospective application, we will prepare a third column, class. And the third column would be for the beginning balance of the previous year, the beginning balance of last year. Okay? So if there are no retrospective restatements or retrospective applications, class, our financial statements will just be end of this year, end of the current year, and also the end of last year. But if there are retrospective applications and retrospective restatements, aside from the end of this year and the end of last year, we will also have the beginning of last year. The beginning of last year would simply be the opening balance of the earliest prior period presented. Okay. So in theory, retrospective application and retrospective restatement may be very complicated, class. Okay. But again, in the preparation of your financial statements, ultimately, it will simply result in the preparation of an additional column, class, for the beginning balance of the last year. Again, normally, it's just the figures for the end of this year and the figures at the end of last year. Because of retrospective application and retrospective restatement, there will be a need to adjust the beginning balance, the opening balance of the earliest prior period presented. And what is the earliest prior period presented? It is simply the last year, the previous year. So simply present the adjusted beginning balance of the last year. Okay, and that is simply how we deal with retrospective application and retrospective restatement. Okay. Limitations on retrospective application, class, would be very theoretical. Please find time to read the limitations, class. Okay. Disclosures, this will rarely come out in the examinations, but of course you're expected to go over the disclosure requirements. Okay. Okay, important note here, financial statements of subsequent periods need not repeat these disclosures. Okay, change in accounting estimates. You have here, class, paragraph 32, examples, class. This can be a good source for a multiple choice question. Which of the following is an example of an accounting estimate? Which of the following is not a change in accounting estimate? Okay, and that's a general trend, class. You will be asked which of the following is a change in accounting policy, which of the following is a change in accounting estimate. Okay, because many students would get confused whether a certain change is a change in accounting policy or a change in accounting estimate. Okay, and this leads me to paragraph 35. A change in the measurement basis applied is a change in accounting policy. It is not a change in accounting estimate. When it is difficult to distinguish a change in accounting policy from a change in accounting estimate, the change is treated as a change in accounting estimate. Okay. It's important that you have this at the back of your minds, class. Okay. But as for those that are expressly given in the standard as an example, class, make sure to know that this one is an example of a change in accounting policy, while this one is an example of a change in accounting estimate. And you will only be able to deal with those kind of questions, class, if you've gone over the standard. Okay, 36, this is what I was referring to on how to apply prospective application for changes in accounting estimate. Okay, letter A, the period of change. If the change affects that period only, this is the one I said that it will only be applied in the current period. Because let's just go over 5 minutes lang, class. Let's just finish this standard. The period of the change and future periods if the change affects both. Okay, this is what I mentioned earlier. Now, this is the disclosure requirements. Just go over them, class. Now, errors, we have discussed this already. Financial statements do not comply with the standards, class, if they contain errors. Thus, it is incumbent upon for us to make sure that our financial statements do not contain any errors. Okay, here, paragraph 42, we know this already. An entity shall correct material prior period error retrospectively in the first set of financial statements authorized for issue after their discovery. So if it is discovered in this period, it should immediately be the restatement should already be contained in the financial statements for the current year, for the year of the discovery clause. Okay, we have discussed this already, restating the comparative amounts, which would be very similar to our retrospective application. Okay, again, go over the limitations on retrospective restatement. The correction of prior period error is excluded from profit or loss. This one is a very important theory concept class. For current errors class, no big deal. But for prior period errors, you do not change the profit or loss for this year because it will distort the performance for this year. The restatement will just be charged directly to your retained earnings. Okay, all the changes to make the necessary adjustments would be charged to your retained earnings. Okay, accounting estimates by their nature are approximation that may need revision as an additional information becomes known. Okay, this does not mean that changes in accounting estimates are correction of errors. Okay, but this will rarely come into an issue class in the questions that you will encounter. Okay, please again go over the disclosures for prior period errors. And that would basically it class for pass 8. Okay, if we are going to reduce everything that we've discussed to 3 concepts in class, let it be that retrospective changes in accounting policies are to be applied retrospectively, changes in accounting estimates are to be applied prospectively, and prior period errors are to be treated by retrospective restatement. Okay, and of course, please don't forget about the definition of terms. Okay, so let's spend the last 3 minutes, class, for questions if you have any, class.